So there's a lot that it tells us. The first thing is the number is very, very substantial and actually very meaningful. So number one, don't lose sight of the fact that 132 billion of new demand is significant and actually meaningful. Second, the numbers, while modest in terms of their growth, they're growing and actually growing in areas where we are expecting to see an increased level of activity and growth, particularly as you've highlighted. The numbers in ETFs are telling us that, but investment overall. So I think it's giving us certainty that the growth potential still stands for gold, that the case for gold still remains strong amongst the investment community. And also all of this happening, as you've highlighted, with one area that we would have expected to be down, jewelry, being down. So I think it's a positive number. It's also going into the summer months when things kind of slow a little bit. Yeah. And I think it's actually very encouraging for what we're seeing. And I think it's structural. So what I think we're hearing and seeing more and more from investors is waiting and seeing for what exactly is going to develop on the monetary side. I think the news that you've just highlighted in terms of the revision of employment numbers is something that's really critical, because that is a key catalyst for gold, when the Fed will move on rates, when the dollar will show signs of weakness. And it's actually looking like, as expected, these revisions are starting to show more impact from trade-related discussions, the potential for tariffs, and actually these numbers are starting to show weakness. So I was expecting a little bit more from the Fed this past week, but it came out with no cut. Now we're getting all but certainty, and maybe even the administration, echoing what they've been saying, which is you need to move on rates. And actually, that might start to be a lot more commonplace in terms of the rhetoric that we're having right now. And investors are standing there holding their gold, increasing their overall level of exposure to gold, and looking to continue to put more to work in gold. So the couple of key points to highlight there, these are the ETF flows, which still isn't the lion's share of where investment is basically being held. The investment being held in OTC flows, which is actually continuing to be strong and has been for the last 5 to 6 quarters. But again, what it does tell us when we see the flows in ETFs, that the investment dollars are quick to move, and they can move and be meaningful. I think Europe is the one market that I continue to watch, because I think what we compete with in gold is an appetite for ongoing risk assets. And right now, I think Europe's still behind where you're seeing North American flows, which have been record setting, as well as Asian flows in ETFs. So I'm keeping a close watch on what's going to develop in Europe and how risk assets are going to continue to play a role there, because I think that that's the market that we could see yet again, another one of these tipping points where flows come quickly to market. And again, it's sticky. Remember, it's sticky. The flows are not seeing outflows. That's what's key right now. It's anywhere where you're having investment dollars being put to work on the physical form of gold that basically doesn't have a disclosure mechanism. So that would include private banks, that would include wealth offices, that would include those that are buying in physical form, whether it's global or here home at the U.S. or whatever it might be. But it also can include some institutional stock that might just be held and not disclosed by those financial institutions that hold it. But at the end of it, it's actually consumption of gold, and it's consumption of gold in that format that is consistent with investment. So we look at that and we get very comforted by the fact that it's finding a home, and it's actually finding a home with those that are actually holding on to it. I just mentioned Asia. I think it's a key market to watch in particular, the key region to watch. I think in particular, watch China. And again, appetite for risk versus protective assets to offset risk. So China's had record flows. It continues to be a market that dominates. As we move beyond the second quarter report that we have and into July, we're showing some signs of the investor maybe looking to take a little more risk in China. So that's a key market to keep a close watch on. I think other markets around the globe that are teed up to be material. Japan is a market that has very good conditions for investors to look to diversify away from yen and bonds and into gold market activities. There's an ETF market that's very robust there. But again, back on the home front in the U.S., this is a market that's actually looking at more like 2 to 5% allocations. That's what asset managers are talking about. It's not this 1.25% that we've heard in the past where we've seen the numbers. We're talking more like 5% allocations. And again, what's important as well is that's coming along with a message that says it's sticky, don't sell. If anything, add to your allocation. Well, I think that the market in the U.S. is unique and actually has a really interesting characteristic in terms of its buying behavior. We see that the conditions in the U.S. for well-disclosed and high-volume activities in the bar and coin market usually during a market condition where the administration might be questioned. A Democratic administration where there might be more concern amongst that buying community that the cost of government, the cost of spending, the conditions of government might be leaning more towards having something a little less in the mainstream investment landscape, so bringing it into the borrowing coin environment. So it's not a big surprise for us to see that the conditions for borrowing coin continue to be less interesting for those in the U.S. But again, the institutionalized and the commercialized forms of retail buying have been picking it up in the ETF market. But in China, again, across the board, ETFs and borrowing coin showing consistent flows there. So you're actually seeing a condition of accumulation. It's a good question. I think that maybe that could be playing into the psyche of those that are actually in the bar coin market. But again, what I'd say is probably more likely is probably less of a concern around the conditions that would normally bring those investors to the market. So, but high prices do impact what does take place in retail consumption. And that's actually to your point earlier around the jewelry market, which is what we're seeing across the globe, a significant decline. I think it most certainly is. And again, our number at 160 some odd tons this quarter is down relative to what we've been seeing over the last few quarters. But again, what I'd highlight for your listeners is that these are numbers that are at or near record-setting levels. So when we see a decline from the 240 we saw in first quarter to 160 roughly in the second quarter, we see this still to be super strong. And actually, our survey report tells us that these central banks are continuing to think about gold as a key reserve asset. So the channel is very strong. It might be a little more price sensitive than maybe we were expecting. And we expect it to be material, maybe not record setting in terms of the flows over 1,000 tons. But again, it will be a continued theme of ongoing buying from central banks as they diversify away from a weakening dollar and weakening dollar assets. So we work with a couple of organizations, and in particular, we spend a lot of time working with metals focus. We have a very robust process of validating their data. So we stand behind the numbers and we feel comfortable and confident on them. But when you start getting into sovereigns buying and entities that are linked and related to the different activities that go along with central bank reserves, ultimately, you have to be very careful and cautious. There might be a time lag. There might be an entity that's being used for a particular purpose or reason on the shorter term. And we do our best to actually make sure that the numbers are complete and clear, but also very robust before we publish them. So we are comfortable with the mechanism and the fact that the numbers stay off the grid. You know, we have had examples in the past where several months after the accumulation has taken place, a particular country might come out and make the declaration under the IMF framework. So we feel good about it. And I'd say that the numbers are as robust as you're going to see from anybody in the community.